And Steve, you've been looking at something a bit closer to home, something called Adyen.
Okay, yeah. So I've spoke about Adyen a few times here. It's a Dutch payments company that I think gets overlooked quite a lot. Its customers are pretty much sort of the big boys in corporate America. It's kind of big competitors are Square and Stripe, if you've heard that. So it's in the same kind of vein as that. They actually spoke about it on Motley Fool today. I don't know whether you saw it. Bill Madden spoke about it quite positively, which is strange because they don't often speak about non-American companies on there. But their earnings, Steve, were pretty good, I thought. So much so they were down 15% on the back of them. So see if you can spot why. Okay. So, and again, sorry, just before I do start, if you really are new to investor relations and things like that, you should have a look at Adyen's earnings because the way they break it down makes it so easy to understand. So if you look at payment processes like Visa and things like that and you don't understand their earnings, try Adyen because they'll explain what each segment means. So, process volume for Adyen was 421.7 billion. That's up 41%.
This is euros.
This is in euros, yeah. Net revenue was 721.7 million, and that's up 30%. So your process volume times by your take rate equals your net revenue. So EBITDA came in at 372 million. Margin was 52%, down from 64%. Free cash flow conversion was 80% of EBITDA, down from 90%. CapEx was 8% of revenues, up from 6%, and full-time employee Steve grew to 3,332 from 2,180. So a big jump in employees. So surprisingly, there's a few misses in here versus Wall Street's expectations, mostly due to a reduced take rate, which I've explained in previous episodes that Adyen switched to a volume-based discount. So the bigger the customer, the more volume they put through Adyen charge a lower take rate. So if you're putting 10 million through, you get one take rate. If you put in 500 million through, you get a different take rate. So it's volume-based discount. A few changes, Steve, at the top for you. They're going back to co-CEOs. Peter van der Doos is the current CEO. He's actually had quite a bit of ill health recently, so they're trying to help him out a little bit. Here we go for a pronunciation. The CFO, Uida Haga, is stepping into that role.
Okay.
He's also expanding the role because he's going to be assuming the responsibilities for the chief operating officer as well because the incumbent has stepped down. So it's going to become a larger, expanded role, but then shared between two people. I've got the geography growth for you as well, Steve. So just to let you know, EMEA, that's Europe, Middle East and Africa, was up 20%. North America up 45%. Asia Pacific up 44%. And Latin America up 36%. So I had a quick look through the results, and I think it's quite obvious Adyen's investing heavily in its staff. It's further building out the business. Its guidance was unchanged. The Adyen management thinks it can grow its business for about 30% per year for the foreseeable future. And its actual aim is to bring CapEx back down to 5% of revenue. So it was down 15% after all of this, Steve. EBITDA growth actually only fell to about 4%, but when you think it's adding 30% new employees just in the last 6 months, clear plans for what they want to build, and it's actually waited to do any hiring because during the pandemic, talent was very scarce and thus was very expensive. So Adyen's adding staff, Steve. I mean, 50% year on year, 30% new employees in the last 6 months, almost all of them going into tech. Meanwhile, its competitor Stripe has just laid off 14% of its employees. I think Adyen are in a pretty much a position of strength here, and I own this one and you don't. Is it too expensive still for you?
Don't know. I haven't looked since it went down 15% and grew quite a lot. I was going to say, so adding headcount and quite significant amounts of headcount swims against the way the tide is going at the moment, right? We see basically tech companies tending towards laying people off. Not universally, but that seems to be the vast majority of what we're seeing right now, even though US economy seems to be doing all right jobs-wise. But I quite like this, considering that nearly all of the numbers are sort of fairly healthy up-wise. They're getting better. Revenue through the door, that margin you said was 52%. That's about level with where it was before. I mean, it's very high, but you kind of expect that from a company like this.
It's actually lower. Yeah, 64% is usual for Adyen, but you got to think about what they've done in that meantime. So they actually think that hiring a bulk of people now and taking the hit now will mean that in the future they won't have to do as much hiring, and they think that revenue will easily accelerate beyond this current hiring patch. So.
Yeah, so I like moving against the direction of things otherwise, but that's not to say I want the kind of companies that we've been talking about, the Googles and the Amazons and so on, to be doing that. I think they're doing the right thing for them because they are overstaffed and it's starting to eat into margins, basically. They're unable to push through inflation, especially wage inflation, or not as well as they would like to. Adyen's moving in the right direction and moving at a pretty decent rate. I assume its balance sheet is pretty good because the balance sheets on these things generally are. Yeah, it was the last time I looked, long time ago, and growing like that with that kind of cash conversion, you wouldn't expect them to be. Well, you'd be surprised if they thought we really need to speed this up by taking on some debt. So, 15% drop interest you. There was a point quite a while ago, early when you got this, and it kind of ran off a little bit and went up an awful lot. And then I think it might have come all the way back again at one stage for you, and then went off again, and I've lost track of where we are now.
Yeah, so I mean, up at one point I was up about 90-odd%, so I was ready to do my post it to Paul to annoy him, and then it fell all the way back down to I think I was down about 10% at one point, and then I pushed back up past and ended up about maybe 25% past it, and now I'm about level. I went under yesterday, but today we're up about 6%. So I've made some of that back. I think I'm just slightly in the green. But this is around the price I was happy to pay, a year and a half, 2 years ago when I originally bought. It might have been even longer than that, Steve. It might have been 3 or 4 years ago. I was happy to pay that price. And I am happy to pay the price for it again today. I think it's one of those companies that reinvests an awful lot into itself. So you can look at its PE or whatever in a vacuum and say, wow, this is an expensive company. But when you actually sit and drill down, you think, gosh, this is a premium business, which is really, really loved by by the people who use it. So it has next to zero churn, and it's a smart business as well. You can't help but think these CEOs were very forward looking when they sat there and said, come on, let's just pause hiring during the pandemic. Paying £300,000 for a tech guy, and right now you could probably get you probably get 3 or 4 for that kind of money.
Yeah,
so,
that's what I was thinking.
Yeah, so it's been a very, I mean, whether you can give them credit for that, maybe it's a bit of luck, bit of credit, but it's a pretty smart move, and they're sat here now just reaping the benefit, and I would expect to see this company do very well, at least in the near future. Whether they can keep this, I mean, they're talking about 30% for what they think is a fairly long time. 30% revenue growth is very difficult to keep up, but if they manage it, this stock will look super cheap in a few years' time.
I guess the sort of short-term headwind is recession, right? You think less money going through those pipes, less. I get their take rate goes up, so they're protected a little bit from that if volumes come down a lot. But in general, the Visas and MasterCards of this world always think that a bit of inflation is a good thing for them. Not so much that it breaks things and people stop spending, because then that slows everything down. But generally speaking, a bit more coming through is good. So recession is the sort of short-term worry. Reason to keep an eye on this?
It definitely is, yeah. I mean, a recession is going to hurt a lot of businesses, isn't it? I think that's the key point. But Adyen's definitely not immune from it. But it's difficult to doubt these guys because they're sat looking at the numbers all day. They're sat looking at the solutions. They're hiring people, and you think to yourself, well, they've got the pandemic completely right. So are they pitching it right? Here forward as well. It's a tricky one for me. I think, yeah, you're right. If the recession hits and it's deep and people cut back spending, then Adyen's not going to do very well. It's just not going to grow at its 30%. But if we get that soft landing, Steve, that we're beginning to believe in, which feels like a rug pull, feels like a rug pull ready for us. But if we get that soft landing, especially in the EU, that'll be crazy because they're an area not famed for its growth, even in the good times. But if the EU can manage it, well, I mean, Adyen's all over the world, isn't it? So. We'll see. I think Adyen's biggest problem is the the constantly strengthening dollar. I think if the dollar gets too strong, this is probably what's going to hurt Adyen the most. But I was looking at its ex eBay revenue, which is quite interesting that they break that out for you, because eBay is quite a big customer of theirs. If you take out the ex eBay revenue, the revenue actually grew in the 70s.
Wow.
So yeah, pretty interesting company. I think it's one for your watch list and one for you to do a bit more digging in.